It is 8:32 a.m. Pacific Daylight Time. It's the 18th day of September 2025. This is episode 1171 of Bitcoin, and we got all kinds of stuff for you on this Thursday. It's all the news that you can use about Bitcoin and more. We're going to start out with CZ sounding the alarm as a SEAL team uncovers, well, fake IT workers linked to North Korea, of course. Then we're going to have a relatively long one about ARK as well as Spark. These are apparently, according to Roy Scheinfeld from Bitcoin Magazine, the channel factories that we've been waiting for. I hope he gets a little bit in depth into ARK and Spark. I've been waiting for these myself. Betting on the color of Chairman Powell's tie. Yes, it happens. And then, of course, of course, Jerome did actually, come out and give the FOMAC minutes. As you know, we got a 25 bips basis cut on the Federal Reserve overnight lending rate, and immediately Bitcoin dumped. It was amazing. At this point, it is only sell the news. It doesn't, and I've said this before, it doesn't matter what the news is, but there had been times where like a piece of news would come out, and instead of selling, people would actually buy a bunch of Bitcoin. Now it doesn't matter. Any news at all, if it's got Bitcoin in the name, or if it's something that directly affects Bitcoin, you immediately dump it. Apparently that is now the way. So we will talk about those that FOMAC meeting as well. And then Canada is going to be in the news. They're stealing money again, while Australia, in a surprising move, relaxes rules on stablecoins. I would never have thought that in a million years. And then the SEC has cleared the path for ultimate shitcoinery at the industrial scale. Get ready for it. And Santander is going to finish us out for the day. But first, let's go on over and check out what CZ is yelling about. He's sounding the alarm as a SEAL team uncovers 60, count them 60, fake IT workers linked to North Korea. Zoltan Vardai, killer name, dude, from Cointelegraph. North Korean hackers are stepping up efforts to infiltrate cryptocurrency companies by posing as IT workers, raising fresh security concerns for the industry. Well, according to Binance co-founder Changpeng Zhao and a team of ethical hackers, CZ sounded the alarm Thursday on X about the growing threat of North Korean hackers seeking to infiltrate crypto companies through employment opportunities and even bribing exchange staff for data access. And yes, we've seen this before. Quote, they pose as job candidates to try to get jobs in your company. This gives them a foot in the door specifically for employment opportunities related to development, security, and finance. Quote, they pose as employers and try to interview and offer your employees. This is a weird sentence. During the interview, they will be a problem with Zoom, and they will send your employee a link to an update which contains a virus that will take over your employee's device. So in the act of poaching your employees, they figured out a way to insert a virus into your system. Man, that's just cruel. That's like adding insult to injury, man. But anyway, other North Korean agents give employees coding questions to send them malicious sample code later, pose as users to send malicious links to customer support, or even just flat bribe your employees, outsourced vendors, for data access. Quote, to all crypto platforms, train your employees to, not download files and screen your candidates carefully. Now, here's the full statement. It's just a screenshot from CZ. And in fact, he says all the things that we were just talking about But the one that I really I'm kind of floored by this one. This is actually kind of brilliant when you think about it, because they're posing as employers, right? So if you're paying your employees crap, then they are an attack vector that sits inside your own company. So, holy shit. Just read it again. They pose as employers and try to interview or offer your employees employment. And during that interview, they will become a problem with Zoom, and they will send your employee a link to an update which contains a virus that will take over your employee's device, or they will give your employee a coding question and then later send them, quote, sample code. Your attack vector as a company, as an employer, you are being attacked through your own employees. Now, that's nothing new. You know, I've gotten sucked. When I was working at Texas Tech, I got a phishing email that looked like it was from Texas Tech Human Resources. I mean, it had the seal of Texas Tech, everything. It was very well done. And I got screwed. Thankfully, I wasn't the only one in the organization that got screwed that way, but I definitely got hosed. And that was a phishing attempt from a completely different vector, right? That was being tricked into thinking that you had an internal institutional email, right? This is attacking people that may already be disgruntled with your company, either because, I don't know, because let's just say that you're not paying them enough, or I don't know, the barbecue for the company isn't big enough. Who knows? But they are leveraging the employee itself. Not only are they trying to become employees, if they can't even do that, they've got a whole other team of people that are like, well, let's just go after the employees that may be disgruntled with the company and offer them employment. Because that way, you have the employees' direct attention. This is a very dangerous situation for crypto companies. I'm just saying. The warning follows similar concerns from Coinbase, which reported a new wave of threats just last month. In response, Brian Armstrong, Coinbase CEO, introduced new internal security measures, including requiring all workers to receive in-person training in the United States, while people with access to sensitive systems will be required to hold U.S. citizenship, as well as submit themselves to fingerprinting. Quote, we can collaborate with law enforcement, but it feels like there's 500 new people graduating every quarter from some kind of school they have, and that's their whole job, Armstrong told Cheeky Pint podcast host John Collins. Now, Zhao's warning came as a group of ethical hackers called Security Alliance, or SEAL, compiled the profiles of at least 60 North Korean agents posing as IT workers under fake names, seeking to infiltrate U.S. crypto exchanges and steal sensitive user data. Quote, North Korean developers are eager to work for your company, but it's important to not get scammed by imposters when hiring, Security Alliance said in a Wednesday post on X, sharing its new repository for North Korean impersonators. The repository contains key information on these impersonators, including aliases, fake names, emails used, along with websites, both real and fake citizenships, addresses, locations, and the numbers of firms that hired them. Salary details, GitHub profiles, and all other public associations are also included. In June, 4 North Korean operatives infiltrated multiple crypto firms as freelance developers, stealing a cumulative $900,000 from these startups, illustrating the growing threat, Cointelegraph reported. The White Hat SEAL team was formed to combat these exploits, led by White Hat hacker and paradigm researcher Sam Samson, I guess is how you pronounce it. SEAL coordinated more than 900 hack-related investigations within a year of its launch, illustrating the growing need for ethical hackers, Cointelegraph reported August of 2024. Now, North Korean hackers, like the infamous Lazarus groups, are the main suspects behind some of the most devastating cryptocurrency heists, including the $1.4 billion Bybit hack, which has been the industry's largest hack so far. And throughout 2024, North Korean hackers stole over $1.34 billion worth of digital assets across 47 different incidents, a 102% increase from the $660 million stolen in 2023. If you are hiring, you need to be extra careful, because now you're not just combating incompetence and people just lying to get a job. Now you're hiring people that are extremely competent and have nothing but ill will against you. So just, good God Almighty, be aware. Let's shift gears completely and talk about Arc and Spark. They're the channel factories we've been waiting for. Roy Scheinfeld out of Bitcoin Magazine. Visions of future technology are often prescient about the broad strokes while flubbing the details. The tablets in 2001: A Space Odyssey do indeed look like iPads, but you never see the astronauts paying for subscriptions or wasting hours on Candy Crush. Channel factories are one vision that arose early in the history of Lightning Network to address some of the challenges that Lightning has faced from the beginning. Despite having grown to become Bitcoin's most successful Layer 2 scaling solution with instant and low-fee payments, Lightning's scale is limited by its reliance on payment channels. Although Lightning shifts most transactions off-chain, each payment channel still requires an on-chain transaction to open and usually another one to close that channel. As adoption grows, pressure on the blockchain grows with it. The need for a more scalable approach to managing channels is clear. Channel factories were supposed to meet this need, but where are they? In 2025, subnetworks are emerging that revive the impetus of channel factories with some new details that vastly increase their potential. They are natively interoperable with Lightning and achieve greater scale by allowing a group of participants to open a shared multi-sig UTXO and create multiple bilateral channels, which reduces the number of on-chain transactions and improves capital efficiency. Achieving greater scale by reducing complexity, Arc and Spark perform the same function as traditional channel factories with new designs and additional capabilities based on shared UTXOs. Channel Factories 101. Channel factories have been around since the inception of Lightning. A factory is a multi-party contract where multiple users, not just two, as in Dryja Poon channels, cooperatively lock funds in a single multi-sig UTXO. They can open, close, and update channels off-chain without updating the blockchain for each operation. Only when participants leave or the factory dissolves is an on-chain transaction needed. Channel factories offer a number of important advantages. By enabling multiple off-chain channels to be spun up from a single on-chain transaction, they dramatically reduce the load on the base chain. Participants can rebalance funds amongst themselves efficiently without needing to touch the chain at all. New channels can be created on demand inside the factory with no cost beyond what was already paid at the factory's creation. The ability to tweak the ratio of channels to on-chain transactions makes channel factories one of the most capital-efficient scaling approaches available for Lightning today. Still, it's no coincidence that channel factories have largely remained on the drawing board despite their promise. A channel factory generally requires all participants to be online and cooperative to update its state unless special arrangements or protocols are in place to handle asynchrony. For example, Lightning service providers can't use channel factories to manage downstream channels with their users because all peers need to be known at the time that the factory is created. Without a way to incrementally add peers to an existing factory, the model becomes impractical for nodes whose scalability is built into their business model, as is the case with, well, Lightning service providers. Moreover, handling exits from the factory, especially when participants are unresponsive or malicious, involves complex mechanisms that might require participants to sign a large tree of potential exit transactions covering every possible combination of cooperative and uncooperative behaviors. Imagine a 5-person factory where one peer goes offline or goes rogue. Each of the remaining peers would need pre-negotiated, pre-signed exit paths for every eventuality. Without automation or covenant support, managing this becomes a combinatorial and operational nightmare. These technical and UX constraints makes it hard to deliver a seamless user experience or to scale such systems in production. We've seen several proposals to optimize channel factories since 2019 with continuing interest but little production deployment. Well, that is until now. So here's a brief history of channel factory proposals. One early and very comprehensive proposal for channel factories came from Konrad Buchert, Christian Decker, and Roger Wattenhofer in their 2017 paper titled Scalable Funding of Bitcoin Micropayment Channel Networks. Their design allows a group of participants to lock funds in a single multi-party UTXO and open multiple channels off-chain between pairs of participants. Each state transaction, channel open, close, or rebalance, requires a complete set of pre-signed transactions. This ensures that every participant has a cryptographically secure way to exit the factory if needed. However, the Buchert-Decker-Wattenhofer construction has a serious scalability limitation. Any update to the factory state requires every participant to be online and sign off on that change. As the number of participants increases, the number of required signatures and pre-signed exit paths grows exponentially, as do the coordination overhead, the storage burden, and the headaches. Efforts to improve on this model have leveraged newer Bitcoin features. Taproot simplifies the structure of exit transactions by allowing their conditions to be encapsulated in a Merkle tree of scripts, with only the sending path revealed at redemption. This reduces both transaction size and privacy leakage. Op check template verify, or OpCTV, a proposed soft fork, would dramatically streamline factories by enabling pre-committed exit paths without the need for exhaustive pre-signing. With OpCTV, a factory could commit to a set of exit transactions at the time of creation. Each participant would know that they can unilaterally exit in a well-defined way, reducing both interactivity and operational complexities. Despite such progress, practical deployment has lagged. The barriers to full participant interactivity and complex signing schemes, especially in the absence of OpCTV, are simply too high. Arc and Spark, next generation channel factories. Two recent projects, Arc and Spark, reimagine the channel factory with different trade-offs. While neither project explicitly markets itself as a channel factory, their architectures effectively realize many of the goals that early channel factory proposals aimed for. Since both are based on a shared UTXO and both are natively compatible with Lightning, Spark and Arc represent modern incarnations of channel factories that leverage today's tooling and assumptions. At last, both aim to preserve the benefits of channel factories, reduce chain usage, scalability or scalable liquidity allocation, and while resolving key weaknesses around liveliness, interactivity, as well as exit complexity. And most importantly, both projects take a pragmatic approach to scaling. They work within Bitcoin's current consensus rules, avoiding the need for soft forks or new opcodes to be useful today. UTXO sharing. Arc introduces a UTXO sharing model built around the concept of virtual UTXOs. Instead of assigning users individual on-chain outputs, Arc lets them transact off-chain using a shared pool of liquidity managed by an Arc server. Users transact by requesting that a new distribution of VTXOs, or virtual, the virtual UTXOs, the VTXOs be included in the next round when the Arc server creates an Arc block aggregating recent user activity and posts a new shared UTXO to the blockchain. So Arc lets users pass VTXOs among themselves and periodically settle the distribution of the VTXOs in the shared UTXO via batched anchor transactions on the blockchain. Users can also perform out-of-round transactions, which instantly move VTXOs between users without waiting for the next round of anchor transactions. In this case, the Arc server cosigns the out-of-round payment, which may be compromised. Let's do that again. In this case, the Arc server cosigns the out-of-round payment, which may be compromised if the Arc server and the sender collude to double spend the VTXO. However, the receiver can decide whether to accept the risk on the basis of the Arc server's reputation and take the funds immediately, or to wait until the next round. Spark takes a different path to shared UTXOs that builds on the concept of state chains. The fulcrum of Spark's shared signing protocol is the Spark operators, or SOs, who come together in a consortium called a Spark entity, or SE. When a user joins Spark, they deposit funds into a shared signature address controlled by themselves and the Spark entity. The SE and the user pre-sign a withdrawal transaction, ensuring that the user can always exit unilaterally. The payment occurs whenever a new withdrawal transaction appears, which creates a new current state. Over time, the history of transactions takes on a tree structure, branching off from the original shared UTXO, and each terminal transaction owned by a user is called a leaf. Naturally, after each change, the SOs must delete past keys used for the past owner, i.e., pruning old leaves. And only one of the SOs in the SE must do so for the system to work securely. This allows Spark to offer trust-minimized, self-custodial, off-chain payments while keeping the base UTXO unchanged. Like Arc, Spark also introduces some new assumptions about trust. Spark requires at least one SO, or some higher configurable threshold, in the SE to act honestly and delete outdated withdrawal transactions. The result is a, quote, moment-in-time trust model, in which trust is only required at the time of transfer. The system maintains perfect forward security as long as operators delete their key shares after a transfer. Once the keys are deleted, even a compromised or malicious operator cannot retroactively affect past transactions or steal funds, and a deletion by any SO counts for all the SOs in the SE, distributing responsibility among multiple operators. Lightning interoperability. To interop with Lightning, both Spark and Arc rely on swaps facilitated by LSPs. That's Lightning Service Provider. These LSPs must participate in a given fork, or rather in a given Arc or Spark entity, to act as bridges. They execute Lightning payments on behalf of users in exchange for the assets inside the respective systems, VTXOs in Arc and leaves in Spark. The process is secured by atomicity, like atomically, like atoms, atomicity. The LSP receives only the VTXO or leaf once it can prove that the Lightning payment has been successfully completed by providing a pre-image. This allows users to make Lightning payments without operating a Lightning node themselves, and it anchors both systems firmly into the broader Lightning ecosystem. If it walks like a duck, well, channel factories increase scale by leveraging shared UTXOs to amplify Lightning scalability. By that measure, Arc and Spark are unequivocally channel factories, albeit sporting the latest fashions in VTXO and state chain technology. Given what shared UTXO models like these are already achieving, we can expect great things from the Channel Factory Labs in the near future, especially if new opcodes are added to L1, and that means the actual Bitcoin code. Bitcoin is L1 or layer 1. That's what they mean. Both Arc and Spark are significant achievements in themselves, but they also validate Lightning. Without being able to interoperate with other sub-networks like Liquid, Fediment, Cashew, etc., these revamped channel factories would be far less valuable, and it's Lightning that lets them interoperate virtually anywhere Bitcoin can go. The emergence of Spark and Arc is not a sign of Lightning's limits, but of its indispensability in today's Bitcoin economy. So there you go. Yes, it's all of this may be a bit above our pay grade insofar that there's only so much that can really be described as to how this stuff works in an article out of Bitcoin Magazine, unless you want to dig into like a Shinobi article, which can get very, very technical. It's just that one of the problems with Lightning that we've had is that, like my son, take my son as an example. He just turned 13 years old. Before his birthday, he spun up a Bitcoin full node, not even pruned, a Bitcoin full node, waited weeks for the initial block download, spun up a Lightning node after it got set, got Electris on there. I mean, he did it all himself. I'm very, very proud of him. He's got a Lightning channel. Whoop-de-doo. So what? He can't use it. Why? No channels open. So I had to open a channel with him from my Lightning node. And even then, he's got no outgoing liquidity. He's got incoming liquidity because I provided him a channel with I think I put for demonstration purposes, I just put 20,000 sats on it. It's not even really that much of a usable channel when you think about it, but he had 20,000 sats of incoming liquidity. So what can he do with that? Not a whole lot. In fact, he can only receive sats up to, about 20,000 sats. It gets a little fuzzy after, when you start hitting the limits, but he only had incoming liquidity. So I put out, a message on Nostr and I said, hey, here's my son's Lightning node. Here's the address. If anybody wants to open up a channel with him, please do so. And somebody did. Not only did that help with a little bit more of incoming liquidity for my son's node, it gave him outgoing liquidity as well. And he was finally able to use his node. Dude, that's because my son is really interested in how all this stuff works. Imagine if you're somebody who doesn't give a shit. You just want to be able to buy a cigar. That's what these channel factories are supposed to help with. Arc, especially when it first came out, when the white paper first dropped, it was supposed to clear all that shit up. This incoming versus outgoing liquidity, all that stuff. I'm really hoping that we start seeing more of this functionality come up for Lightning, but I'm also still looking at things like eCash and Fediments and Cashew and all that kind of stuff, because at one point or another, this is all going, it's almost like an amorphous mass just spinning out in space. And the gravity is starting to pull it all together, but slowly, and we can't really get a feel of what the shape of this looks like. And it won't be until we reach a critical mass on all these technologies forcing themselves together and it ignites like a sun in space. And then it starts gleaming brilliance over everything, and then you can see. what this means. Right now, only the really highly technical people, the guys that are crawling around the guts of channel factories, amphetamines, and cashew, only those guys can actually see the potential. And I'll bet you my ass that even they are going, I'm not sure how all this is going to work together. But I guarantee you, the way the universe works, all of these technologies that are going to smash together, they're going to hit a critical mass and they're going to ignite like a sun. And the second that happens, we will know what the hell's going on. Hey, you want to bet on what color Chairman Powell's tie was yesterday? Well, myriad users are betting on that exact thing. This is from decrypt.co. A peculiar but revealing market is getting serious traction on Myriad. That's a like poly market, right? It's a betting. It's a place where you can bet on stuff. Will Fed Chair Jerome Powell wear a purple tie during the September FOMC press conference? As of now, the crowd overwhelmingly believes yes, he will. But it's not just about fashion. This prediction market taps into a deeper symbolism around the Fed's public identity. According to a recent report by Columbia Business School, Powell's choice of a purple tie is no accident. Brett House, economist and professor at Columbia, noted that Powell's consistent use of purple is a part of reinforcing the Federal Reserve's image as a non-political entity in the era of heightened polarization. Here's what's known. When asked, Powell said purple was once just a personal preference, but over time, he began to see its utility. Quote, maybe not red, maybe not blue, so I wind up wearing purple. He saw purple as neutral ground, signaling a lack of alignment with either side of the political spectrum, and lately, it's become something of a signature. He explicitly frames this aesthetic, this tie color, as helping project the message that the Fed is strictly non-political, not embracing party red, not embracing blue team, but purple in between. So when people are putting money on Powell wears purple, they aren't just betting on wardrobe chance, they're betting on consistency, signaling, and public messaging. Here's what the market looks like on Myriad. The question is, will Jerome Powell wear a purple tie during the September FOMC press conference? The large sentiment says yes. Significant volume is leaning that way. Exact figures shift with time. Resolution rules: it must be purple or a pattern where purple is the dominant color. Shades like lavender or violet qualify. Red, blue, or burgundy do not. The market typically closes shortly before the event, and official feeds/video resources will decide. Because of Powell's established pattern and public statements, the yes side seems to carry weight beyond random guesswork. Here are things that could upset the odds. Lighting or camera differences. A tie that looks violet on camera might register differently under stage lights or in certain video streams. Tie patterns and mixed colors. A tie with multiple colors where purple isn't dominant could, well, create disputes. Last minute changes. Powell could change his wardrobe plan. Things like his stylist decisions, availability of a tie, or even mood might matter. So there you go. There's the bet. So did he wear purple? He, in fact, did wear a purple tie at the September FOMC press conference, which occurred yesterday, about a couple of hours after they decreased the federal fund overnight rate by 25 bips. So Fed Chair Powell, in the meeting or in that press conference, said specifically, and this is another story, that FOMC is divided on additional rate cuts in 2025. Hey, I thought we were supposed to get multiple rate cuts this year, and now already we're getting some hawkish comments, even though we just reduced the federal funds rate. But Vince Quill from Cointelegraph tells us much more. U.S. Federal Reserve Chair Jerome Powell said that the 19 members of the Federal Open Market Committee, or FOMC, remain divided on additional interest rate cuts in 2025. At Wednesday's press conference after the Fed's 25 basis point rate cut, Powell said that the central bank is trying to balance its dual mandate. There's three mandates though, right? Moderate long-term interest rates is the third mandate, but he's talking about the dual mandate of maximum employment and price stability in an unusual environment where labor market is weakening even as inflation remains elevated. And Powell said, quote, "You will have seen that we have 10% participants out of 19 who wrote down 2 or more cuts for the remainder of the year and 9 who wrote down fewer than that. In fact, a good number of cases, no more cuts. No more cuts." You get pissing people off there, Jerome. Powell said that the median FOMAC projection from the Federal Reserve Summary of Economic Projections, the Fed's quarterly outlook for the United States economy that informs interest rate decisions, projected interest rates at 3.6% at the end of 2025, 3.4% by the end of 2026, and 3.1% at the end of 2027. Quote, "I would encourage people, as always, to look at the SEP through the lens of probability. And so there are different possible outcomes and likelihoods rather than a certainty," Powell said. Sounds like a hawk to me. Yesterday's rate cut is the first of 2025 and brings the U.S. interest rate down to a range between 4 and 4.25%. Crypto investors continue to speculate on the likelihood of additional cuts in 2025 as they have seen a bullish catalyst for risk-on asset prices, which benefit from credit expansion and suffer from credit contraction. Quote, "Roughly $7.2 trillion to $7.5 trillion remain parked in money market funds whose yields will now begin to fall. And that creates a powerful incentive for capital to move back into equities and alternatives like crypto." Matt Mena, crypto research strategist at exchange traded product provider 21 Shares, predicted. Mena said that Bitcoin is poised for a Q4 rally that will likely catapult its price past its all-time high of about 124,000. 62% of traders on Polymarket say a prediction is that the BTC will hit 130,000 in 2025. Don't believe the numbers. Just stack sats. Whatever Mina's saying about this price projection, it's just take it with a grain of salt, please. Nobody knows what the hell is going to happen. But those are some relatively hawkish comments out of the Fed right after they just cut 25 basis points. So we're going to have to see. Now the question becomes, and let me get TradingView up, has the 30-year yield and the 10-year yield been affected by yesterday's rate cut? Well, it so happens that the 10-year yield rose. Let's see, where was it? Let's see, we got that news at roughly 11 o'clock on Wednesday. Okay, so here it is. Wednesday, September the 17th at 11 o'clock a.m. my time, which is Pacific, we had a bump of 0.62% in the yield of the 10-year. And then it came back down to where it had been previously. By early this morning at 2 a.m. my time, it came back down to 4.045%. However, it is now sitting at 4.12% after a couple of really large green candles. And green in this case does not necessarily mean good, especially for people who like to take a little bit of risk. What did 30-year do? It has the exact same candlestick pattern. However, they're saying that, and for the 10-year, hey, their numbers work. It was supposed to be between 4 and 4.25%, and the 10-year is at 4.12%, so that works. The 30-year, however, has jumped to 4.73%. So not exactly good for homeowners because that's sort of the 30-year loan. It's okay. It'll be fine. We're chilling out here with Oshi. Circle P is open for business. The Circle P is where I bring plebs with goods and services. They're just like you. They're not big companies. They don't have money for advertising. You know, they do what they can. And I like to give them a little spotlight here on the Bitcoin and Show through the Circle P, because they've got stuff for sale. And you might want to buy that stuff for sale for Bitcoin. Because if you're not selling your goods and services in Bitcoin, you ain't in the Circle P. Today, it's Oshi Good at oshigood.us. Oshi's got some of the best hodl butter, hodl bars. He's got mint chocolate hodl bars. He's got banana chocolate chip hodl bars. He's got, what else has he got? He's got BTC nodes. Well, actually, BTHC nodes. They're little chocolate candies with THC in them. But he's best known for hodl butter. What is hodl butter? Well, no better way than to give you Oshi's own definition. Hodl butter starts with local, hand-picked, and sorted pecans straight from Southeast United States. More nuanced than a 2-hour Bitcoin podcast, this small batch craft delicacy can be enjoyed as a topping on anything edible, or just straight out of the reusable glass jar itself. Ingredients are pecans, maple sugar, sea salt flakes, cinnamon, and black pepper. It's that cinnamon and black pepper, just that, He's got them in 16-ounce jars, and you, again, can buy them in sats. He also has them in, 8-ounce jars as well. So why don't you go over to oshigood.us, Oshi, O-S-H-I, oshigood.us. Pick yourself up some hodl butter or anything else that he's got in stock, because he usually sells out pretty quick once he manufactures these things. Make sure that you use Bitcoin and in the coupon code. That lets Oshi know that I made a sale for him. And in the value for value advertising model that I've developed here on the Bitcoin and podcast, he gets to determine how much that sale was worth to him. And if it was worth something to him, he cuts me that in sats and either gives me a zap or some other way. The Circle P is not, we don't do contracts here. This is a digital handshake, and it's just good plebs trying to help other good plebs. So do your part. Help Oshi at oshigood.us. Buy some of his stuff and make sure that you use Bitcoin and in the coupon code. Let's run the numbers. CNBC, futures and commodities. Energy sector getting the hurt put all over it. Oil, West Texas Intermediate down 2/3 of a point to 63.61. Brent North Sea down 3/4 to 67.44. Natural gas, however, is being pummeled. It's being beaten like a redheaded stepchild. 4.87% to the downside, back below $3 with you, natural gas, to $2.94 per thousand. I guess news came out that maybe we were going to have a milder winter this year, because yes, news like that will get natural gas down like by 5 points. Gasoline is down a point itself to hovering just right around $2 per gallon. And Murban crude, everybody's light sweet crude, is down 2/3 of a point to $70.51 per barrel. Shiny metal rocks are having a bad day too. Gold is down 1.13% to 36.75 and 7 dimes. Silver is down 1/4 of a point, but platinum is up 1 1/4, while copper is down 0.8. Palladium rounding us out, it's 2/3% to the upside. Then ag, not looking good. Not looking good at all. Which is odd, because all the reports that I'm seeing from harvests, yes, I follow a bunch of farmers on Twitter, and all of them are complaining about wet conditions and high moisture rates in their grain harvest, whether it's canola, corn, wheat, sorghum, it doesn't matter. They're all having problems, right? That should actually send grain commodity prices up, but we may not see that until numbers from the silos start coming in, because harvest is in full swing right now. Some of them are coming to the end of their harvest. Most of them that I see are either just beginning or in the middle. So right now, wheat is down 0.47, soybeans are down 0.7, corn is down 0.6. Sugar is actually chocolate is the biggest loser today. It's down 2.15%. The only thing making any traction is coffee. It's 1.25% to the upside. Live cattle are up 0.5, lean hogs are up 1/4, and feeder cattle are up 0.75 point. The Dow is up 1/4, and the S&P is up 0.5. NASDAQ is up over 1%, and the S&P Mini is up almost a full percentage point. Bitcoin chilling out, 760. That's a $2.35 trillion market cap, and we can finally get 32.1 ounces of our favorite shiny metal rock with our one Bitcoin, of which there are 19,922,498.05 of. Average fees per block remain stable, 0.03 BTC taken in fees on a per block basis. There are about 60 blocks carrying 135,000 unconfirmed transactions waiting to clear at high and low priority rates of 3 Satoshis per VByte. And hash rate has fallen again. We are now down to 986 exahashes per second. Mining death spiral is imminent. The Bitcoin and podcast has a website, bitcoinandshow.com. That's bitcoinandshow.com. Go subscribe. Give me your email. Don't worry. I'm not going to sell it. I'm not going to give it away. I'm not going to leak it. I'm not going to do any of that crap. If you want to know, like, especially when I finally drop a new episode of the Cathedral series, you'll get an email and it will have a link to it. Hey, man, sign up at bitcoinandshow.com. You can also, that's also a place that you can support the show. If you want to, I've got a tier that's like $50 a year. Yeah, I mean, it's like if you're getting value out of this show, then show me some value back. And you can do that at bitcoinandshow.com. That's bitcoinandshow, all one word, .com. Go there, sign up, throw me some money. Not to put too fine a point on it. Okay, from yesterday's show, the third mandate, progressively worse with 5,000 sats. Thank you, brother. Says, here's some sats for a new cat toy or for some vet bills, whichever comes first. Thank you, sir. No, thank you. Jason High with 2,000 says, thanks for the show. I appreciate that, sir. Yodel. Sorry, it's always Yodel. It can't be Yodel. That would not make any sense. Yodel with 513 sats says, not a lot of chatter about MSTR/MSTY or treasury stocks these days. Yeah. Amazing how that shit works, right? Pies with 1,000. Thank you, sir. No, thank you. Code with 500 says boost. Actually, he says boost. And then Sandy, Bitcoin Sandy with 500 says great chat. Great chat. That's the weather report. Welcome to part 2 of the news that you can use. Them Canadians up there in Canada are going crazy. A possible $32 million seizure at Trade Ogre Exchange has apparently occurred. This is out of atlas21.com. According to The Rage, the cryptocurrency exchange Trade Ogre, known for its non-KYC policy and popular among Monero users, is at the center of a controversy that has seen over $32 million disappear. The platform, which only allowed registration via email, abruptly ceased all public communication 2 months ago, leaving its website offline since July 29th. On September the 16th, for the first time after nearly 2 months, the exchange's funds began moving to an address reportedly controlled by the Canadian government. According to Arkham Intelligence data, in just over 4 hours, the linked Bitcoin address accumulated more than 126 BTC, which is about $15 million, all originating from Trade Ogre. On September the 10th, an op return transaction made by the non-custodial exchange Change Now displayed the following message. Quote, crypto assets controlled by the RCMP crypto actifs control par la GRC. And RCMP means Royal Canadian Mounted Police, seemingly referring to Canada's National Police Force. The same message also appeared in an Ethereum transaction associated with the draining of another $17 million worth of Ether. The situation raises significant legal questions, the Rage reports. Even if the Canadian government had indeed confiscated the funds, it would raise serious ethical concerns. Funds held on a custodial exchange do not belong to the platform operators, but instead to their customers. And using a non-KYC exchange, at least for now, is not a crime. The lack of a legal requirement for the Canadian government to publicly announce seizures makes the situation even more ambiguous. According to the Rage, the op return message and the Ethereum IDM message could represent 1, a prank blaming the Canadian government for a hack or exit scam, 2, an attempt by RCMP officers, an attempt by a single RCMP officer to ridicule users who lost millions of dollars, 3, an actual government operation carried out in a questionable manner. So far, the Royal Canadian Mounted Police have not responded to the Rage's request for comments. Trade Ogre users remain uncertain about the fate of their funds. So, if what we've read here, boys and girls, is that the RCMP basically heisted all of the money off of this Trade Ogre exchange, and Lola Leets from the Rage, and that's a great outfit, by the way, I really like the Rage, is suggesting that this is illegal because that those funds really belong to the users. And while she's correct, there is a fourth possibility here, that the RCMP sees a way to dox these users. And here's how they'll do it. In a couple of days, the RCMP will probably, this is the way that I see it happening. Okay. I don't know if it'll happen. All right. So don't take me at my word, but this is a possibility that the RCMP could, in a couple of days or a couple of weeks, announce, yes, we did take this money. Yes, we acknowledge that it is not our money. Yes, you have, as a customer of Trade Ogre, the ability to get your money back. And here's how you're going to do it. You're going to bring your Canadian ID or driver's license or passport or whatever. You're going to give us your name, your address, your wallet addresses, like your account number at Trade Ogre, or however it was that Trade Ogre was doing the accounting of who owned what. And we're going to want the destination address of where you want this shit sent. And it doesn't cost, honestly, it cost the RCMP virtually nothing to do this. Sure, it'll cost a couple of officers some time and, probably maybe like 2 or 3 different staff members. Yeah, so that'll cost to be able to do all this, But guess what they get out of it? You get thousands of people who self-dox themselves because they want the money, which means they got KYC'd anyway. It's a completely different way to shotgun KYC. This time it's not the exchanges that are doing it. No. It's just the government of Canada doing it, or at least in this case, their law enforcement extension of the Canadian government. See how this works? And that's exactly what I expect to have happen. I exactly expect the RCMP and the GFC, or whoever the hell else that group was, to come out and say, sure, you can get your money back. Make sure you bring your driver's license. Now, on to Australia. This is surprising. This is out of the block. Naga Avan Namoyo is writing this one. Australia eases They actually eased licensing rules for stablecoin intermediaries. Australia's Securities and Investment Commission on Thursday announced a class exemption that lets licensed intermediaries distribute stablecoins without requiring separate regulatory approvals, which is a first for that country's crypto rules. Stablecoin intermediaries are entities like crypto exchanges and brokers or platforms that facilitate the distribution, trading, or transfer of stablecoins to users without creating the stablecoins themselves. Firms overseen by Australian Financial Services will be able to offer fiat-pegged digital assets without holding a separate AFS market or clearing license, according to Thursday's notice. The relief will take effect once the instrument is registered on the Federal Register of Legislation. By lowering interim licensing frictions for intermediaries of AFS-issued stablecoins, Australia is sketching the contours of its crypto regulatory framework while preserving consumer protections. For stablecoin issuers, it offers a clearer route to distribution ahead of formal payments and platform legislation. The measure arrives via ASIC's Stablecoin Distribution Exemption Instrument, which temporarily removes all licensing obligations for secondary distributors of a named stablecoins subject to consumer safeguards. Distributors must, for retail clients, make the issuer's product disclosure statement available, and the relief sunsets on June the 1st of 2028, so they got a few years. Initially, the instrument lists Catena Digital Pty Limited and its AUDMA stablecoin as the initial name stablecoin and issuer. ASIC indicated that it may extend the rule to additional issuers as more stablecoins secure AFS licensure. The exemption is meant as a bridge to forthcoming national legislation. The government's March 2025 policy outline proposes a dual-track regime covering digital asset platforms and payment stablecoins. It also explicitly flags that businesses will not need a financial market license just to provide certain stablecoins and wrap tokens under the new settings. More broadly, stablecoin regulation is taking root in several jurisdictions. The United States under Donald Trump recently passed, the Genius Act. Locations like Hong Kong and China are also working on stablecoin rules, albeit with different approaches. Yeah, you think? So, in a surprising move, one of the most authoritarian, totalitarian states in the world, and that being Australia, has actually relaxed these rules, which leads me to a conjecture. What if? What if stablecoins really are designed by governments? Because there's always been, the CIA came out with Bitcoin. I don't know. I don't think so. However, it wouldn't surprise me if they didn't go, shit, we got to wrap our heads around this real quick. So here's what we're going to do. We're going to make this thing called a stablecoin. But we're going to let that go underneath the shadow. We're going to let Tether do whatever it is that they're going to do with it. We're going to let Circle do whatever we're really not going to make that much noise about it. But here, and this is for all Western countries. This isn't just like the United States. I'm saying a cabal of people get into a room, have a very expensive lunch, do some hookers and blow, and then after a while they retreat to the man cave with a bunch of brandies and yet more cigars and say to each other, what we're going to do is we're going to engage in some misdirection here. We're going to have these stable coins over here, which we invented, but we're going to let these pseudo government-controlled entities like Tether and Circle, we're going to let those guys handle that shit. We're really not going to talk about them for at least the next 3, maybe 4 or 5 years. In the meantime, however, what we are going to start hammering is the idea of a CBDC, a central bank digital currency. That's what's going to scare the piss out of everybody. And then when they get scared enough, they're going to look at stablecoins and go, there's the pressure release valve. The trick is we own both of them. It would not surprise me in the least. Meanwhile, the SEC has cleared a path for waves of shitcoinery, the likes of which you have never seen, crypto ETFs, because they've provided us with new listing standards, and Vince D'Aquino from Decrypt describes it well. The U.S. Securities and Exchange Commission signed off Wednesday on a new generic listing standards for commodity-based trusts, a move that analysts say could swing the door wide open for crypto products beyond Bitcoin and Ethereum. This is exactly what happened with shitcoins, ICOs, altcoins. There was a couple of them. You know, you had Litecoin, you had Bitcoin, you had Litecoin, you had Doge. And then in 2015, here comes frickin' Ethereum. And after that, all hell breaks loose. Well, the new standards approved for NASDAQ, CBOE, BZX, and NYSE ARCA now allows trusts that meet defined criteria to list without a separate commission order. They bar leveraged and inverse structures, but they do create a pathway for commodity or crypto-linked products to qualify more quickly. Quote, it was expected, but big. Because it's going to mean that about 12 to 15 coins are already good to go, Eric Balchunas, senior ETF analyst at Bloomberg Intelligence, told Decrypt in a call. Quote, you start getting the coins coming in waves, he said, adding that this factor is, quote, pretty big, considering that right now only 2 really exist under the 33 Act. Balchunas was pointing to the Securities Act of 1933, often shortened to the 33 Act. It is a U.S. statute that governs the initial offer and sale of securities to the public and requires issuers to register their products with the SEC and provide full, fair disclosure in a prospectus. That statute has long been, quote, the more appropriate place to file them for commodity-style funds like Spider Gold Shares and BlackRock's iShares Bitcoin Trust, Balchunas explained. Quote, it's going to be real nice for investors to have 33 Act spot ETFs with reasonable fees and low trading spreads in the ETF wrapper, which has been vetted by the Securities and Exchange Commission. It's a beautiful thing, Balchunas said. No, Eric, it's not. This is shitcoinery on an industrial scale, and you should be calling it out, but you're not. It's bad enough that we have Ether as an ETF. I don't need a Doge ETF. I don't need a Litecoin ETF. This is ridiculous. But continuing in a section on the discussions around the standards, the SEC said that the rules are designed to help prevent fraudulent and manipulative acts and practices while improving market transparency. These steps help perfect the mechanism of a free and open market and a national market system, the discussion reads. In any case, the standards would require underlying assets to trade on surveilled markets, have a futures history, or already back an exchange-traded fund with significant exposure. Trusts must also publish daily holdings, net asset values, and liquidity policies, while market makers face trading limits and firewalls to block misuse of non-public information. Still, Balchunas thinks the SEC's latest action sets the stage for the broadest expansion of crypto ETFs since spot Bitcoin products debuted last year. Asked about ETF expectations for the near term or within the year, Balchunas said that he sees Solana and, of course, as I said, Litecoin leading the next wave of approvals. Quote, you're not going to see anything on one day, Balchunas said. Solana and Litecoin ETFs could be the ones that come out first, probably within a month, he said, adding that Dogecoin, oh, for fuck's sake, why am I calling this so right? Dogecoin could follow soon after. An XRP ETF, meanwhile, may lag a bit because, quote, the futures aren't exactly 6 months old, which is a criterion, so they might be a little later than the other ones. None of this crap needs to come to market. None of this needs to come to market. This is all garbage. This is like reliving 2017 all over again. It's awful. They got a whole new round of dumbass, vacuum-headed morons waiting in the wings with real money, but in this case, other people's money to invest in the same shit that we called out as crap a decade ago almost. Just, it's bad. It's bad. It's bad. Maybe Spain's Santander Bank will end us on a good note for this Thursday. Bitcoin News, Alex Larry writing, Santander's Open Bank launches Bitcoin trading for retail customers. Oh, thank God it's not Doge. Open Bank, the fully digital arm of Spain's Santander Group, has launched digital assets trading for retail clients in Germany. The move is a big step for one of Europe's largest financial institutions into the digital asset space, with Spain to follow in the coming weeks. The new service allows Open Bank customers to buy, sell, and hold Bitcoin, as well as the 4 top altcoins: Shitcoin number 1, Shitcoin number 2, Shitcoin number 3, and Shitcoin number 4. They don't even need to be named. It's crap. It is a list of shit. But it'll be directly on the bank's investment platform, so yay. The service sits alongside Open Bank's traditional investment products such as stocks, funds, ETFs, and robo-advisory services. By trading within its own platform, Open Bank eliminates the need for customers to transfer funds to third-party exchanges. The service is also under the European Union's new market in crypto assets regulation, and we all know what that shit means. Coti de Monteverde, head of crypto at Grupo Santander, said, quote, by incorporating the main cryptocurrencies in our investment platform, we are responding to the demand of some of our customers and continue to strengthen a broad range of products and services through an agile, simple technology platform backed by one of the world's leading financial groups. End quote. Open Bank has set fees at 1.49% per trade, with a minimum of €1 per trade. The bank will not charge custody fees, a detail that could appeal to retail investors wary of hidden costs. In addition to the initial 5 tokens, Open Bank will add more digital assets in the coming months. So falling right in line with the SEC's new freaking guidance that allows every shitcoin under the sun to be sold to any idiot with money. I feel bad for these people. This launch is part of Santander's broader blockchain and digital asset strategy. Open Bank already serves more than 2 million clients across Spain, Germany, Portugal, the Netherlands, the US, and Mexico, making it one of Europe's largest digital banks. And Santander has dabbled in digital assets and blockchain before. Recently, it had been reported to be considering entering the stablecoin market, potentially issuing its own digital asset services. DZ Bank, the country's second largest bank, launched a digital asset pilot with 700 cooperative banks in 2024. Deutsche Bank announced earlier this year that it would roll out a custody service for digital assets in 2026 with fintechs Bitpanda and Taurus. Meanwhile, Sparkassen Finanzgruppe, a network of saving banks serving almost 50 million Germans, will introduce Bitcoin trading through its Sparkasse app by mid-2026. And yes, I don't really pronounce German that well, so forgive me for all my German listeners. Anyway, elsewhere in Europe, BBVA, the global financial group headquartered in Spain, already offers digital asset services to clients in Switzerland and Turkey and will roll out retail Bitcoin trading in Spain once it gets regulatory approval. So everything is on track. If you're smart, if you're a European and you listen to this show, it's only Bitcoin. It's the only one that matters. All the rest of this is complete trash, it's complete garbage, and it's designed to do one thing and one thing only: take your money and put it in somebody else's pocket. I'll see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.